Hi, everyone, and thank you for joining us for a brief update on some select investment topics this quarter. Many of you may wonder where we get these topics to discuss, and we find inspiration in many of the questions that you ask when speaking to your planner or questions you may send in over email. Other ideas come from major headlines throughout the quarter that were contributing reasons really to market movements. And lastly, just some of the research we do on our own work for the investment committee discussions. So who is the we I'm talking about? Well, I'm Angela Palacios, Director of Investments here at the Center. And joining me today is Jacqueline Jackson, the Center's Portfolio Manager, and Nick Boguth, Portfolio Administrator. Nick, can you kick us off with an update on markets this quarter?
Gladly. Markets and the economy are still riding the high of greater than expected fiscal stimulus at the beginning of the year, an easy Federal Reserve, and the economic reopening. Generally speaking, when economies are expected to do well, stock prices will rise and bond prices fall due to the upward pressure on yields. Benchmark 60/40 portfolio consisting of both U.S. and international stocks, and the U.S. aggregate bond index is up over 7% year to date, with the S&P 500 leading the way at over 15%, international stocks represented by the MSCI EAFE at a positive 9%, and the U.S. aggregate bond index at a quiet negative 1.6%. Gross domestic product has shown a sharp increase this year as well, along with inflation readings that have heated up. Check out our recent blog on inflation for more on that. Many Americans have received at least one dose of a vaccine, with high vaccination rates among our most vulnerable population of people 65 and over. You can see here over 80% of those individuals have received vaccination. Now that the 12 to 16-year-old community can receive a vaccination as well, we are only awaiting approval on a vaccine for younger children. It's likely that we will see something later this year.
Thanks, Nick. Markets always pay close attention to what the Federal Reserve is doing with interest rates, so I wanted to give a little update there. Recently, they met in June. They left short-term rates unchanged as expected. The monthly pace of asset purchases by the Federal Open Market Committee is also unchanged, but market expectations of future interest rate movements rely strongly on the dot plot. That's something you might hear about. And that's really a summary of individual projections of year-end target interest rates for each of the 18 senior Fed officials. Even though not all of them get a vote, you can see in this chart I'm sharing that now 13 of the 18 officials assume interest rates will increase before the end of 2023. And that was kind of a big deal in the news cycle because before the June meeting, only about 5 officials were saying that. So it's important to remember that these officials don't actually get a vote. So the chairman cautions people really not to rely on this. But based on this news, the bond market may be pricing in rate hikes earlier now than they were before. Looking at jobs, there's another interesting chart I want to share here. And that is, there's really been more job openings in the economy than there has been people unemployed. This is still driven by a number of reasons like pandemic-related issues, caregiver needs, ongoing fear of the virus, and supplemental or extended unemployment insurance benefits. As these abate, I think we'll see people returning to the workforce and the bottleneck in unemployment alleviated. If not, this could be a larger than expected driver of inflation because wages will continue to experience upward pressure. If there is higher than expected inflation, there are many implications that we're thinking through. And Jacqueline's going to talk to us a little bit about those.
Absolutely. So I'm going to talk a bit about the real estate sector. And so let's think about this a little bit. The real estate sector benefits from the rising value of assets with rising rates as well as inflation-linked prices and leases. So from a market standpoint, sector variation at the individual company level create some investment opportunity for stock pickers. Investors who think inflation will be strong in the coming years, they could target companies with properties that have shorter leases. Also, anticipation for government-backed projects in the near future highlights infrastructure companies. However, what to buy is not really the challenge when it comes to this sector. The real challenge is understanding when to buy this sector. And for that reason, many experts recommend having an ongoing real asset portfolio allocation permanently in your portfolio to protect against unexpected inflation. So let's also think about what's happening to real estate from a political standpoint. So some of you all may have heard Joe Biden's proposal for, give me a second here, I want to make sure I'm being accurate with the name. The American Family Plan. And so the American Family Plan is about a $1.8 trillion investment and tax credit program for American families, especially servicing children over 10 years old. So, you know, it's a fairly expensive plan, and it has to be funded. And so one of the proposed ways of funding the plan is changing the favorable tax treatment on 1031 exchanges. And so just a quick recap on what those are. So traditionally 1031 exchanges, or they're also known as like-kind exchanges, you may have heard it that way, allow investors to defer real estate taxes by rolling profits into their next property purchase. So the new tax proposal seeks to remove tax deferments on property gains over $500,000. It's largely meant to impact the wealthiest of investors. However, some experts fear that it could also impact small business owners. But before we kind of get in a panic, you know, it's important for us to stay aware of these issues. But at the end of the day, you know, it is just a proposal. It's not legislation that's been introduced or passed at this point. So definitely don't want to cause panic around it. Just something that we are watching and keeping an eye on, and we will continue to monitor it and see how things play out.
Those are great points. If you zoom out and think of inflation a little bit from a higher level, you know, if inflation is more persistent than is expected, it's important to understand the areas that we think about leaning towards in portfolio construction. I went into this in more detail in the inflation blog last month, but the short answer here is your real assets are a powerful way to potentially combat inflation. But along with that, you know, different areas like value company stocks that have been out of favor for many years can help. Active management within your bond portfolio can take advantage of areas like Treasury inflation protection bonds, or you know, different areas that might benefit as well. That can be very important. I think we have one last topic to update on with cryptocurrencies, because they've been a hot topic this year. So we wanted to give you an update there.
Yes, it's hard to not talk about headlines happening in the financial world, and crypto is definitely one of those. Seeing a large crash in a lot of cryptocurrencies this year. This isn't the first time cryptocurrency has lost a majority of its value in a flash crash, and it probably won't be the last. Speaking of Bitcoin, in 2012, 2015, and 2019, it fell more than 80% from its previous high. At 32,000 at the time of recording this, Bitcoin is currently about 50% off its previous high. So I thought this was a fun math check. In order to reach an 80% drawdown, it would have to fall another 60% from here. It's a volatile asset class. In an aggressive portfolio, actively managed cryptocurrency can generate market-crushing returns or losses. Look out for a blog in the coming months for more on cryptocurrency, trading, speculation, blockchain technology, threats to that industry.
Thanks, Nick. And thank you all for taking time to listen, and we'll see you next quarter.